Hello folks, this is part one of our discussion of chapter 10. Those important concepts we need to know about basis in property, and we're going to go over some non-taxable exchanges. So let's jump in and see what we need to understand. So the basic underlying concept in the tax law is that you have a realized gain is the difference between how much you realize minus your adjusted basis. So realize means you actually have money. You've exchanged one asset for another, typically cash, but other assets may be involved as well. Whether it actually shows up on your tax return or not is whether it's recognized. So the first thing is looking at it as a realize. That means it's actually been exchanged. And second, then whether or not it's recognized on the tax return as income. So here's the calculation. So if you're looking at how much you realize from a transaction, okay, it's the fair value of what you receive. Now, if it's cash, that's pretty easy. But if it's anything that you get in return, if it's a car, if it's a boat or whatever, the fair value of that is what the amount realized, including any debt that the buyer assumes. So you get rid of a property that is subject to a mortgage, they assume your mortgage, that is included in the amount realized, the amount you receive. Okay, selling expenses reduce the amount realized. So what do we mean by fair market value? This is the definition IRS uses. Willing buyer means that there's no coercion, no way held a gun to someone's head to come up with this sale, and that everybody knows what's really happening with the property. There's no hidden problems, there's no contamination under the ground, anything like that, or if there is, everybody knew about it. Okay, they all know the necessary facts. So, example, taxpayer sells land, buyer's buying it for $30,000 and the truck. Okay, the buyer's based in the truck. He bought that truck $25,000 years ago. That really isn't a matter. All that we care about is the fair value of it right now. Okay, so how much is the taxpayer realizing? They're going to get $30,000 in cash, and they're going to get the fair market value of the truck, or $12,000, for a total of $42,000. That's what would be compared to their basis. So, as far as the seller is concerned, the buyer's basis in the truck isn't relevant. Okay, taxpayer sells land, $200,000, and then the buyer is assuming $40,000 debt. I have a mortgage on this property. So I'm going to pay, the buyer's paying me cash and taking over payments on the debt. All right, and then we have some selling expenses. So the calculation, we add in the mortgage assumption and we subtract out the selling expenses. Now, adjusted basis. That is what we need to subtract from the amount realized to get our gain or loss. So what is this adjusted basis? Well, start with the initial basis. Most of the time, that's what we paid for it originally. Then if there's anything that adds to that, capital additions, we add that and we subtract out capital recoveries, biggest one being depreciation. That gives us our adjusted basis at any given time on a property. So the time that we're going to sell it, we can figure out the adjusted basis by knowing these three things. Okay, so initial basis is usually what we paid for, like we mentioned, and it doesn't matter whether we borrowed the money to pay for it or we paid for it with cash or whatever, paid for it with marbles. It's the initial basis is the amount we gave up for that property. Okay, and lots of costs necessary to get it ready to use could be included. Title insurance, delivery, all kinds of legal fees in order to transfer title, that sort of thing. Now, capital additions, commissions, anything that you have to do to make sure you can record and have ownership of the property. So if you went into you bought a car, the cost of title and stuff right up front, the license fee and all that, that's part of the cost of that's a capital addition. That's part of the asset cost. In addition, over time, you may make improvements. And this is where the IRS and a lot of companies come into a lot of disagreement, whether an improvement actually increases the property's value, lengthens its useful life, or converts it to a different use or a better use. Companies want to deduct it for their tax purposes, so they think it's a repair and are routine. And IRS would say, no, it's an improvement. And there have been a lot of court cases about that. It's not easy to tell. Here's some examples, the things that have been. And you can almost, in every case, take that and change it to something that would be more like a repair. This came up earlier when we talked about property taxes. You have to watch for special assessments. They are not property taxes. They are considered capital additions to your house. All right. However, if your driveway was eaten away by salt or something like that, paving that could be considered a repair because you're bringing it back to use. So this is not a exhaustive list, nor is it always easy to tell the difference. Okay, vacation home, when you pay $15 to remodel the bath, $18 to keep the home in good operating condition. In this case, $15 is going to be considered a addition, a capital addition, and the $18 is just going to be a repair, is not going to be added. But again, if depending on what the bath's condition was and what had happened to it, maybe getting some new things in there would not be considered an improvement. So that's the challenge. Now, if you remember, so many of our properties can be depreciated using bonus depreciation from Chapter 7 that this becomes a less of an issue because it doesn't matter whether it's an addition or it's a repair, the same result happens. Either you take it as a repair, as a deduction, or you deduct it as a bonus depreciation for an addition. So that it's made things a little simpler going forward. Okay, capital recoveries, the biggest one, of course, is depreciation expense. These others are going to be very rare and usually not worth talking about, but depreciation is the one that we are going to see. Okay, paid $80,000, we deduct $11,000 as depreciation, pay $25,000 for repairs and maintenance. Repairs and maintenance, by definition, is not an addition, does not change the basis, but our basis is reduced by the amount of depreciation. So as we deduct part of the cost of the asset as depreciation, then that reduces our basis so that when we sell it, we are not going to have as high a cost as we did when we first bought it. And that's what's critical to remember. Basket purchases, a little bit about this. We allocate using fair value or fair market value of the property. So if we get a deal on property like we say here, paid $100,000, but land and building we think it was worth $30 and $90, so we're going to allocate the $100 by using a fair market value, the $30 for the land compared to the $120 for the total and the building. Why is that important? Because land is not going to be depreciated, building will be depreciated, and this will be our basis for that going forward to calculate that depreciation, as well as any future sale of this property to calculate the gain or loss. Okay, now, what if you don't buy property? Okay, what if you didn't go and in a normal transaction pay cash or borrow money and buy something? What if you got it from a spouse, you inherited it, you got it as a gift, or you converted from personal to business use? That's the special rules we need to talk about here for a little bit. Okay, from a spouse. The tax law doesn't want to make it hard to get things between spouses. So basically no tax consequence. So your basis when you give it to your spouse whether this is in a divorce or any other type of scenario, it's just transferred, and the basis transfers with it. Inherited property, a little more complicated. So somebody died, and you inherit. The will leaves property to you. Okay, so that basis to you that inherited is the fair market value on one of those 3 dates. Okay, so it gets adjusted in basis. Doesn't really matter what it was to the person who died. Doesn't matter what they paid for it. Doesn't matter what their depreciation was or anything like that. It's going to adjust to fair value at one of those 3 dates. Okay. If there's no estate tax return, which is most people, because you don't have to file an estate tax return unless your estate is over $5 million. Okay. No estate tax returns filed, then it is the fair market value on the date of death. All right. Or if there is a tax return filed and they elect to have that. So if you file an estate tax return, you can choose the date, and that is one of the dates you can choose. If you file an estate tax return, you can choose an alternative valuation date, and that's 6 months later. Okay. All right. So this is example value as estate was $50,000 when it was died, 56 6 months later on December 6th. Okay, no estate tax return, then it's this value, or if you choose that value, that date. If you file a estate tax return, you could then choose the 6 months later alternative valuation date. The third possibility is if you distribute the property in between those 2 dates, it's the fair value on that date of distribution. So those are your 3 choices. You've got the date of death, you've got the date 6 months later, you've got any date in between the fair value. If it's after the alternative valuation date, then it is and you chose that's the value that you're going to use. Okay, it doesn't matter how much the value changes after the AVD or alternative valuation date. Okay, and this is all up to the executor, of course. Person who died doesn't care 1 iota about it, so the executor gets to choose that and would do so and have to do so with all assets. He can't pick and choose, just for your information. Okay, so another example, if the date of distribution occurs before the AVD, then that's the date we use. Now, gifted property, we're going to save till part 2 of our discussion here, because it's kind of involved. So we'll come back to that in part 2.